Today, I'll be looking at how to minimize taxes when all of your retirement savings are locked in pre-tax accounts like 401ks and IRAs at age 60. Over my years helping clients with substantial pre-tax retirement accounts, I've developed some very specific strategies to reduce tax burdens while maximizing after-tax retirement income. And that's exactly why I'm making this video today, to show you the most effective ways to minimize taxes on your pre-tax retirement accounts starting at age 60. Now, if you're new to the channel, my name is Ben. I've been a financial advisor for almost 20 years, specializing in retirement income, tax planning, and taxes, and I want to make your retirement even better. All right, so let's meet Susan. She's 60 years old, she's single, and she's done an absolutely amazing job saving for retirement. She has $1.9 million all in pre-tax accounts, made up of her 401ks, traditional IRAs, things like that. Now, her $1.9 million puts her firmly among the top few percent, certainly within the top 10% of all savers in the country. So we always want to acknowledge and congratulate folks for that kind of savings. I know that's no small task to put away that much money. So we want to figure out how we can make the most of it. Her spending needs per year are about $80,000, and she's planning for a long retirement, all the way to age 100, just to be safe. Now, Susan is in good health, and she's got a few aunts that are in their 90s, so she's really in this for the long haul and wants to plan accordingly. Now, before we get too deep in the numbers, I want to make something abundantly clear. If you're approaching retirement with no Roth IRA and all of your money in pre-tax accounts, I want you to know that you did not do anything wrong. You shouldn't feel bad or feel any guilt about not having a Roth IRA. The 401k was designed from day one to help you save for retirement on a tax-deferred basis. And remember, the Roth IRA has only been around since the late 90s, which is barely a blink in the context of your decades of saving. And I'll even let you in on a little secret. For many people, especially in the later years of their career, saving into a pre-tax 401k is exactly the right move. These years are often your peak earning years when tax deductions are the most valuable. And here's a mistake I often see. People hear all the praise for Roth IRAs and tax-free growth, and in their final years before retirement, they switch all of their contributions to Roth. Now, the Roth is a fantastic tool, but just like any tool, it has a time and a place and a purpose, right? You wouldn't want to drive screws with a hammer. So, for example, I've met with people 2 years before retirement making $250,000 a year with a retirement budget of $150,000. Now, in that situation, contributing to a Roth is completely backwards. Why pay taxes at your peak income when you could take the deduction now and then undo it later in retirement with something like a Roth conversion at a much lower rate? So it's like this. We want to take the deduction at a 25% rate while we're working and then undo the deduction in retirement at 15%. And we get to keep the difference. So when my income is higher, at a 25% effective tax rate, I want that tax deduction. And then when I'm retired and I have much more control over my income, I undo that deduction with a Roth conversion at 15%. 25 here, 15 here, we keep that 10% difference. That's the power of using the right tool for the right job at the right time. And that's what that Roth IRA is, or Roth conversions. Another mistake that I see many near retirees make is that they look at taxes in retirement through the same lens of their current tax situation, and then they assume future years will look a lot like today. They'll say this woman, Susan, earns $80,000 a year. She pays about $10,000 in federal income tax per year. What's the big deal? What they fail to recognize is that before we retire, our income dictates our taxes. When we're newly retired, our withdrawals dictate our taxes. But once we've been retired for a while, especially if we have a large tax-deferred portfolio, it's really the size of that portfolio that dictates our tax bill really more than any other factor. So it's not about looking at last year's $10,000 tax bill and then multiplying that forward by 30 years for retirement. It's about looking at the total income that will pass through your fingers over the course of your retirement, and then more importantly, the balance of your tax-deferred accounts from age 75 till 90 or 75 until 100, however long you're planning to live. So now let's take those ideas and let's apply those to Susan. So when most people think about taxes in her situation, they imagine paying taxes only on what she needs to spend, her retirement budget. And for Susan, that's $80,000 a year, which of course will need to adjust every year for inflation. So would you believe $80,000 per year over 40 years, that's $6.29 million in lifetime spending. Because believe it or not, Susan will need to double and potentially triple her income over the course of her retirement just to keep buying that $80,000 worth of purchasing power, that $80,000 worth of stuff carried through her retirement. You've got to double or triple your spending. And we've got to account for that if we're going to figure out our lifetime tax bill, number one, and then number two, how do we actually reduce that lifetime tax bill? Here's just a quick breakdown of what her income would look like at 3% annual inflation. Age 60, we've got our $80,000. Next year, age 61, we've got $82,400. Fast forward a little bit, $107,500 at age 70. You can see age 80, age 90, age 100, $261,000. Now, if we count by eights, 8, 16, 24, $240,000. Yes, she's going to need to triple her income by the time she passes away, whether that's at 95 or at closer to age 100. She's going to have to triple her income to buy the same $80,000 worth of stuff. So that is significant income that's going to pass through her plan. And all the income that passes through her plan, of course, we have to pay income taxes on. But here's the catch. And this is where inflation and RMDs change everything. Once she turns 75, the IRS will force her to start taking required minimum distributions. And based on our calculations, those withdrawals will be significantly higher than her $80,000 annual spending need. Over her retirement, those forced withdrawals will total closer to $9.5 million in income, not the original $6.29 million. $6.29 million was the income that she'd like to have based on $80,000, but because of her tax-deferred assets and RMDs, the income that will pass through the plan will actually be about 30% more at $9.5 million. Now, don't worry, we're going to look at some of these illustrations in a moment. I know these are big numbers, and we're talking about future values and things like that. But here's the hardest part to really wrap your head around. In Susan's base case, with no Roth conversions, just meeting her spending needs alone until RMD start, her lifetime tax bill would be about $2.7 million. Now, I know that number sounds completely ridiculous, right? How can someone with $1.9 million saved pay a total of $2.7 million in taxes? It doesn't make any sense. Well, that's the sneaky power of inflation and RMDs. If your income triples over retirement that lasts decades, which is exactly what happens when inflation compounds, well, then your taxes are probably going to triple too. That's why understanding your total lifetime income and your total lifetime taxes is one of the most important parts of retirement planning. If you don't know what those numbers are, it's effectively impossible to plan properly. So let's dive into Susan's tax projection without any tax planning and see where our numbers lie. All right, our first illustration here, this is our tax software Holista plan. If you're a financial advisor, this is the tax software that we use. And this is $1.9 million in all pre-tax with no Roth conversions. And we want to visualize what this means. So just going over just some of the basics on the left-hand column here, single filer, 1.9 million. We're not doing any Roth conversions, as you can see here. We'll add those in our next screen. Our spending is that same $80,000 per year, just an inflation-adjusted $80,000. Of course, we're going to do Medicare, Part D, all those sorts of things. Social Security, we're going to have her collect at $2,500 per month. Again, this is no Roth conversions. This is just the default plan that I think many people would just go out and do on their own. And so the first thing we want to do is assess what her lifetime taxes are going to be. And so these blue columns are Susan's income. So it's a nice inflation-adjusted $80,000. And this looks fantastic, nice and simple. Nothing fancy needed to be done until we hit RMD age at 75. So you can see that her $80,000 has grown to about $101,000. And that's just, the normal inflation rate from the day she retires until 74. And then something interesting happens at 75. Her income jumps up because that's her first year RMD. She's forced to take out additional income from her IRAs, whether she needs it or not. And it starts out very slow, but because your IRA is growing, one, and because two, as you get older, the amount that you have to take out every year goes up, we're going to see these numbers get out of control pretty quickly. These multicolored lines are our different tax brackets. So you can see as more income is pushed out of her IRAs, these blue columns are moving higher. And we don't get to the absolute top tax bracket of 37%, but we certainly get into the 35% tax bracket for a single filer. So you can see, even though she only wanted $80,000 in inflation-adjusted $80,000 per year, at some point in her mid to late 70s, the RMDs take over, and that actually drives her income significantly more than what she actually wants for her retirement budget. And that's where we get this baseline projection of $2.7 million in total lifetime taxes. In addition to federal and state income taxes, we also have IRMA, and that is the additional amount that we'll pay for our Medicare, and it's going to be income-based. And that's what this chart shows. So she starts Medicare at 65, but she doesn't pay any additional premium for Medicare. She pays her normal Part B premiums now all the way until RMDs start at 75. And then it doesn't take too long, those RMDs that she doesn't really need, until we get into this first IRMA bracket. So we pay an additional $1,500 per year for that. And you can see that as her portfolio balance grows and as those RMDs grow, it pushes her into a higher and then higher and then higher IRMA bracket. or towards the end of her life, she's paying an additional $1,000 per month for Medicare because her income is simply too high. Now, much of this is avoidable if we just take some small actions earlier on in retirement, which we'll talk about. So in addition to more federal income tax and more state income tax, she's going to have to pay about another $176,000 for her Medicare because her income is too high. And then portfolio value, just so we're trying to compare apples to apples, it looks like her base projection portfolio ending value is about $8.7 million. Now, I would look at that number and say, we should actually increase your spending because unless it's your stated goal to die with a mattress stuffed full of money, we want you to actually spend this money and have fun with it. But just so we're comparing apples to apples, we'll call that $8.7 million. Now, here's the good news. We can cut down this number significantly with just a couple of small tweaks done consistently. And when it comes to taxes in retirement, small hinges can swing big doors. We don't have to have some large one-time action to make a dent in our $1 million tax bill. Little things done consistently can have a surprisingly large impact. So for Susan, that strategy is very simple. It's a series of $30,000 annual Roth conversions from age 60 until she starts Social Security. By intentionally paying a little bit more in tax in these early lower income years, we can move money into Roth accounts where it grows tax-free and avoids future RMDs. All right, now scenario number 2, now that we've established what we think her lifetime income will be and her lifetime income taxes, what are some simple things that we could do to reduce that bill? So we've got the same parameters here over on the left side, but now we're doing some Roth conversions. In order to make room for the Roth conversions, we're doing some things that are slightly different that I'll start on first. Spending is exactly the same at $80,000 per year, growing with inflation. But the one thing that I did change was Social Security. Now, because we didn't want to push her into higher IRA brackets early on, we wanted to defer Social Security. So rather than collecting $30,000 from Social Security, we're going to defer that and we're going to collect $30,000 from a Roth conversion. It's going to be largely taxed the same, but if we can push Social Security off a few years, that gives us room to do some more tax planning. So she's spending her $80,000 per year plus $30,000 in a Roth conversion. So we pushed Social Security back till 67, and she's going to get a larger benefit. She's not going to get the $2,500 we talked about in the last slide. She's going to get $3,250, and that's going to grow at about 2% per year. So no Social Security, and then it turns on here and grows with inflation. So that's the first tweak. The second tweak that we did to this plan is same spending goals, Roth conversions. So we made room in her tax bracket by deferring Social Security, and we're going to fill that up with Roth conversions. So from 60 until 66, we are going to do a $30,000 annual Roth conversion, and that $30,000 is going to grow by about 2% per year. So year 1, we do $30,000. Year 2, we do $30,000 plus 2% because our income tax brackets are likely going to grow by 2% per year. So we're just going to further take advantage of that. How that looks in the chart is here's our Roth conversions, and then they drop down to no Roth conversions for the rest of her life. Now, in reality, with clients, it's probably not going to be exactly $30,000. It's going to be a specific amount for a specific amount of time. And we're revisiting this math every single year because it doesn't really make a lot of sense to do a projection 40 years in the future, hit print and say, this is how life is going to work, right? Life changes, rules change, brackets change, life circumstances change. We really want to examine this every single year on its own. We want to look forward and say, what's our lifetime income? Because we want to calculate our lifetime taxes. But then we want to bring it back to each individual year and solve each year as a standalone equation. So what do the numbers look like? So we've got a couple different things. You'll remember in the last chart, we just had the blue. Now we've got blue and a slightly darker blue. So we have our base case, ordinary income. That's just for your spending needs. And then we have Roth case ordinary income. So you can see here, and maybe our editing team can highlight those. We've got 1, 2, 3, 4, 5 years of spiked income for Roth conversions. Now you can see her income still goes up from RMDs. So this tells me that we're not aggressive enough with her Roth conversions. We could do them for longer, but just to illustrate the step 1 for this short video, we want to say, what if we just did $30,000 a year for a fixed number of years? Again, we're going to want to revisit this every year for a client because we're still spiking our income a lot later on in retirement. But if we do those few Roth conversions, we take our $2.7 million lifetime tax bill and we reduce that to $1.9 million. And why is that? It's because we reached into the future, we pulled forward some cash flows, and we paid taxes on those cash flows. So there's less in your IRA when RMDs are calculated, which is less of a force out to you. So just by making those small changes, $30,000 a year for a few years, like I said, small hinges swing big doors, By taking those small actions, we've actually saved the client $737,000 over the course of her lifetime. Of course, by giving her more control over her income, we're also saving her some IRMA charges. Now, again, we would probably be more aggressive with Roth conversions and do them longer. We're giving you kind of a broad stroke example here, but she was paying $176,000 in IRMA. It looks like she's going to be closer to $143,000 in IRMA, so that's about $30,000. So that's about $32,000 in savings. You can see here she's still going to work her way through the IRMA brackets, but just a little later. And in fact, we have a little bit of a bump here that we would probably iron out with something more specific than an exact $30,000. And for portfolio value, with no Roth conversions, we're at about $8.7 million, like I mentioned in previous slides. With Roth conversions, even though we're voluntarily paying more taxes now with the idea of paying less, hopefully later, we still have a bigger ending portfolio value, and that's investing in the exact same way. Now, largely because we're paying less in taxes, we're keeping that in the portfolio and it's growing. So that in and of itself makes us an additional about $600,000. So nothing to sneeze at. Now, I would be remiss if I didn't point out that Roth conversions are not a free lunch, right? We are taking money from one investment, we're paying taxes on it and putting it into a different investment. So while that is growing on the other side of taxes, on the friendly side of taxes, there is still going to be a period where we're going to be behind where we were if we wouldn't have paid the taxes. At some point, both accounts have to pay taxes. With the Roth conversion, we're paying it on the front end. But I wanted to show you this chart where we are going to be underwater with our Roth conversion really for a number of years until paying those taxes starts to earn us a profit. Now, somebody's going to pay taxes on this money. Either you're going to pay it in your 90s or maybe whoever you leave the money to is going to pay the taxes. But it is worth pointing out that we are going to be underwater with our Roth conversions for some amount of time. We don't know. But I want to point out that this is not a free lunch. Your investments are going to start underwater by whatever your effective tax rate was. As strange as it sounds, we're voluntarily paying more taxes now in order to pay significantly less taxes later. Lifetime taxes drop from about $2.7 million to about $1.97 million, a tax savings of $737,000. So when you combine lower taxes, lower Medicare premiums, and higher ending wealth, this simple conversion strategy, just $30,000 for a few years, it actually creates over $1.3 million in total benefits to her without taking any more investment risk or without cutting her spending by a single dollar. So if you're over 60 and all of your retirement income savings are in pre-tax accounts and you haven't run the numbers yet on your lifetime tax bill, now is the time to do so. You might be shocked at how much the IRS is on track to get and how much you can keep with the right plan built to suit your needs. So click on the link below. I'll run the numbers for you just like I did for Susan. And that's it for today's video. My name is Ben. I hope this video helps to make your retirement even better, and I will see you on the next one.